Thanks for being with us. This is the first of our actual live webinars. So you get to experience Will Sullivan and myself trialing this format, but hopefully you'll get some good value out of it. And now that I've brought up his name, let me introduce our guest, who is Will Sullivan, Managing Partner of Predictive Analytics Partners. Got some interesting stuff to talk about today in terms of ARR Waterfall. Will, thanks for being here. Why don't you tell us a little bit about your business and yourself, how you got to the business?
Yeah, Scott, great to be here. So I run a company called Predictive Analytics Partners. We help sales ops evolve into rev ops, and then we help CROs really take the next step forward from $100 million to $200 million managing a business to manage revenue movements and revenue types. So we do that through analytics and then organizational design, and really kind of like similar scale matters, we help bridge the gap between finance and rev ops. My background, I started this company about 2 years ago. Prior to that, I was in PwC's M&A team, where I did over 25 deals of tech, B2B tech companies, and some gov tech and some healthcare as well. And so in that time, got very intense into analyzing go-to-market effectiveness, how to build actual value creation to deliver real value, and understand how to build customer data cubes, and using that as a platform to improve the evaluation narrative, which we're going to today.
Awesome. Yeah. So the title for today is basically Achieving Revenue Exit Readiness, leveraging a ARR/MRR waterfall framework. I think you've got some slides. Why don't you walk the group through this stuff, because I do think it's very important element of, and we talk about it being, for exit readiness, but it's also a good way to manage your business is to have this info. So why don't you jump into it, and then audience, feel free to ask questions via the chat. I'm sure I'll interject a little bit myself.
Oh, let me just go on correctly. You got my slides up there, Scott?
Yeah, slides are there.
Yeah, so let's jump right in. We're going to what is revenue exit ready. We'll talk about what is exit ready, and then where does how you bifurcate that to focus on revenue. And then really kind of walk through a phased approach to achieve it, and go into an operational understanding of the MRR waterfall analysis. I find it's easier for most rev ops and sales leaders to comprehend the MRR as opposed to an ARR waterfall. And then the benefits to CFO and the benefits to CRO, and how having a agreed upon combined framework can really bring the two teams together. And then really kind of the key component is where in the life cycle of a SaaS company or a business should a rev ops team implement an MRR waterfall analysis. I'll just jump right in.
Yeah, please.
We're here talking about revenue. Revenue drives so much, but it's really only part of the picture. And I think as we moved away from this growth at all costs to revenue efficiency, CROs really, in order to work better with finance leaders, need to understand how revenue is supported by various OpEx and driving sales and marketing budgets to drive efficiency, but also how it all combines and to create operating income. And that's your first kind of pass at revenue efficiency. But then for revenue teams to really work with and understand finance teams and all the other challenges they have managing other expenses. And that creates that net income line that's so important as we're now in this efficient era of efficient revenue growth. And if you're in private equity, as you know, Scott, from all your exits, you have to understand EBITDA. And I think that the new bar, which is why I help clients, what I'm sure you do as well, is helping C-level or CROs or VP of sales understand an adjusted EBITDA walk. So now that they can speak the same language as a finance team and overcome the GAAP versus non-GAAP issue. And I'll get into it. Now we jump into exit ready. And so when you go to sell your business, you're going to go through diligence. And one of the first things you go through is a quality of earnings. This is a team of CPAs coming in, going through finance, tooth and nail, and it's very challenging, but rewarding as well. Well, what I did at PwC, and is still prevalent today, is getting to this idea of quality of revenue. And so we know valuations come from achieving a certain level of revenue, like 100 million ARR or 100 million in revenue, and achieving a certain growth rate, whether it be higher than the market share or just a standard 15%, and understanding how that combines to show their forward trajectory. But investors want to know about the quality of revenue. Is their growth rate sustainable? How is their revenue made up? And that's when we get into this idea of revenue types. And within those revenue types, we do a review on those to understand quality of revenue. And the most common metric is net revenue retention, which we'll get into. And now, so I say this because just as finance teams that go through a QRV, there will be, especially once you cross the $70 million threshold, there will be a diligence into revenue, and we'll refer to it as quality of revenue. But for the CROs on the call, or for the CFOs who are the revenue leaders in the organization, there's the component of what is your revenue narrative and how effective are you driving that go-to-market. And so I put this screen up here, kind of lengthy, but it really speaks to this idea of what is revenue exit readiness. Is your narrative aligned with your data strategy? Are you data-driven? Are you able to drive effective go-to-market strategies and plays across various segments? And then are you doing it in a way where there's a efficient and sustainable revenue growth? And that's how quality of revenue is analyzed. So I'll pause there. Scott, you have any?
I do have just one question on this. You mentioned sort of the large shift over the last couple of years from growth at all costs to efficient growth, and rightfully indicated that CROs need to be aware of and concerned with things like adjusted EBITDA to help drive efficient growth. But I'd say we still don't see that very often. We don't see companies incentivizing CROs to focus on that. So in my view, while everyone talks about efficient growth, it's starting to feel more like lip service a little bit. How do you react to that?
Yeah.
The customers you deal with are kind of 100 million and higher. That's sort of at the upper half of our customer base. So maybe I have more exposure to 20 to 50 million, and maybe it's different there. But talk to me a little bit about making efficient growth a real thing as opposed to a lip service thing.
Yeah, the way I think about it, best analogy, Scott, and I'm sure you've seen this, you have the CFO that is that $50 to $75 million CFO who is excellent at building a team and implementing initial systems. And he's good at closing the books and, just being a partner to the CEO. But the CFO at 150 or 200 million is a different level, different character, different requirements of a CFO. And so I think about, what does a strategic CRO look like? It's similar to a strategic CFO where they're able, with their words, able to move and shift the market. They're able to identify M&A opportunities and identify if they should be outlaying capital for new market entry or new product release. And so when you get to that north of 150, 200 million, CROs are required to be strategic and understand expansion movements. And do you think a cross-sell strategy or an upsell strategy? Do they look at expanding to a new region or focusing on expanding a new product line? And so that's where you get to this strategic revenue, strategic CRO, and they have to understand the full P&L, and they have to be a partner with the CFO and not just a leader of a sales organization.
I assume these people are not easy to come by.
They are no, and they survived the past 18 months for CROs, and when you find them, you see what a aligned C team looks like. So you don't have the expense versus growth kind of battle between a CFO and CRO, or GAAP versus non-GAAP confusion. You see alignment, and it's exciting. And I would say I've worked with probably over 50 companies. I've gone and come across about 4 or 5 of these types.
Yeah, similarly, for us, we do a lot of work trying to get our customers thinking about ROI on a channel level or a segment level, which means you have to think about costs and how do you attribute costs, how do you attribute marketing talent costs into a segment or a channel, right? And it's just astounding to me the fact that very few people think that, and they're still just they're all satisfied by having good metrics on their revenue, but have no idea what the return on that revenue is. Basically, your quality of revenue issue. So, hopefully we'll see that change more.
Yeah, and I'll get into that, but I think that's also why I had this slide in here, is because I think for the VP of Finance and CFOs in this call, knowing that going forward, you want a strategic CRO who understands the full P&L and even a cash flow statement, is grabbing these VP of sales, a VP of sales going to VP of Finance, and understanding how the P&L flows, understanding the drivers, the way that FP&A and finance does, because you want those people going forward to have a strategic mindset and not just a excellent, script and playbook and process orientation, because VP of sales and CROs are excellent at driving day-to-day execution, but to step back as a CFO does and a strategic CFO does, of where are we going in the next 2 years? How do we get there? And Scott, this is where once you drive that net retention rate up, you're also driving valuation.
Yeah.
And what that is you're signaling this is a very sticky customer base that buys more of what we sell to them. And that just screams product market fit.
Yep.
That's why I'm very passionate about it.
Yep. Let's keep going. Good stuff, though.
Yeah. So let's kind of talk about how do you do this? What does it look like? And so I'll start with, you have to have a single source of record. And that just gets down to, I was going to put these through here. You have to have a single source of record, so you're not having 3 or 4 CRMs and instances, and you may have some, but you need to bring them together so you have a single location to get to your customer revenue data. And then the key is accessing that in Excel. And what I mean by Excel, you need to be able to print this out, export it, and put it in a data room, hence the name of this podcast, and provide it to investors or acquirers to understand and manipulate the data. And so the key about that, we'll get into the next slide, is you need more than one person that can do that. People have to be able to get into the customer revenue data. And the third key is this I would say it is when you can see if a company truly is data-driven. If the way they speak about the business and operate the business is the way the data looks as well. I'm sure you've seen all too often, Scott, someone will have a metric in the data or a dimension in the data that is totally different from the definition used at a C-suite or not used at all in terms of how they go to market. And that's kind of the third component. And let me just get to the next slide.
Before you do, on that point, we, a lot of the customers, when we engage with them that we have, they are reporting on a lot of metrics, but they aren't presented in a way that sort of answers key business questions. It's very inefficient to try to draw conclusions out of the stuff and turn that into actions. So we see these companies over and over again, right? They have their regular monthly meetings or whatever, look at the metrics, everyone kind of glazes over, and then they move on to the next point. So I think it is tangible when you can actually see the companies that truly are data driven, because they've organized their data strategy to basically inform their actions, not just to report metrics. The other thing I just want to talk about quickly is this single source of record thing. So, Jocko and the guys at Winning by Design have done a nice job creating the model of the bow tie concept, right? And the left side of the bow tie is basically new logo acquisition. The right side is sort of existing business dynamics, retention, and all that stuff. In my experience, the data related to the two sides of the bow tie sits in two very different places. Left side CRM, right side ERP. And that causes a problem, right? I mean, that's part of the problem of getting a holistic view is the two different data sets. Is your in your recommendation that there be a single kind of source of record or system of record? Are you suggesting?
No, I'm not.
People put something on top like a Snowflake or Databricks, and that's the single source? Or are you suggesting that they try to get more rigor around renewals and stuff in the CRM? What are you thinking? How do they get to that point?
Man, you are teeing me up for the next slide. But I will answer that this way: it is an issue. I think you think about the Salesforce side of things, and then Gainsight, which is in Salesforce and limited to so many people. It bifurcates the full life cycle. But when I think about single source of record, I think you have to identify, are we going to use a bookings database from the opportunity object from a CRM? Or are we going to use a billings database, which comes from a NetSuite? Or are we going to, or a financial suite? Or are we going to use a revenue database because you're applying some RevRec? And so there's maybe it's a module from NetSuite. And so you start with get down to a singular database. And frankly, the finance team has this. And so if they have it, they need to give access to the RevOps team. And then I'm going to go back to your comment about metrics, Scott. The ability that SaaS tools and AI have provided, I think, has outpaced people's experience and knowledge of how to use them. And so when people throw a pipeline metric over here, then a revenue econometrics metric over here, they're not pulling the story together. And that's why I'm a big fan of the ARR Waterfall framework, because it paints it for you. And so to your question, how do you get the full customer journey visibility for the bow tie? I think there's arguments about okay, do you do that? And how do you do that? And then how do you operationalize it? I think in terms of operating your business and getting to data-driven effectiveness is let's start with, are we going to look at our business based on bookings, billings, or revenue? And then how are we managing the hygiene on that? And then do we have someone, ideally more than two people, who can pull that into Excel, and we have repeatable measures? And a measure is a BI term. So instead of just taking a sum if and copy and pasting it over and over again, like often FP&A will have ARR roll forward, and they're just do sum ifs, but they get limited within Excel to do it across segments and different bucket sizes and different vintages. You have to create the measure, which is a BI term, so you can do this and have one singular data model and apply it across your go-to-market strategy. And then that creates the ability to have a common way to talk about the business. And if you don't have this set up, then you have what happened to one of my clients a few years ago. Very impressive company. If I'd say it, everyone know it by name. They're a top best of breed sales ops B2B SaaS business. And they had some tremendous stories about customer growth and customers loving their product. But when we got into the data, those were just anecdotes, and the trends were all negative. And so that signified to us this was not a data-driven business. This was kind of a thought leader talking, kind of mainly good talking points, but not a business that could drive their growth. So these are the things, these are the details you have to get right. And it starts with, as you said, Scott, some structure around where you put the data. And my answer to that is, let's start with what you know works. Like, how does finance report? And then from there, let's build in the measures so that you can calculate expansion, contraction, upsell, cross-sell, and make sure that we have the right aligned segments. So if you're talking about go-to-market via channels or go-to-market via geo markets or verticals, that is in the data, and that you have a singular way to talk about the business, and the data reflects it.
quick thing before we move on, and I'm cognizant of time because I really do want to get deep into the waterfall. But on daily hygiene, can you talk about any examples where you've seen this done very well, and kind of what the technical and cultural components of that were?
Yeah, I do it. My short answer to that to everybody is, if you go into your Salesforce CRM and you go to dashboards and there's not a admin hygiene or admin dashboard in there, then you know that you've got major hygiene issues. You can go to Salesforce bin or go to Trailhead and get these hygiene dashboards and hygiene reports, and that way they get in there, and that way you have someone viewing them. And then so if you do find them, then the next thing you look for is, are alerts set up? And so a Salesforce admin, I'm using Salesforce as an example because it's so dominant. One, I recommend should be certified. And two, they should be getting alerts daily when a field is entered incorrectly, it doesn't match the right way to put it in, or a field is not entered. It should be a daily report to that admin, and that admin at the end of the day should be reporting up what corrections he had to make. And frankly, the only way to drive change is to send an email to the individual and the boss and said, you made this mistake for the fourth time, stop doing this. I can either put policy around this, or you can make a individual change and do this correctly. So that's the way to do it. You got to go in your CRM and see if it's set up yet.
Yep.
So here's some details and kind of talking points. Lay the data foundation that creates the foundation for a narrative. And now that you are backed by data, now you have a foundation for evaluation. And so you can take the intense, detailed questions that happen in diligence, and you can say, nope, this is how we grew. And while you're saying that, someone's checking it in the data and like, man, this person's on it. This company is going places. And as you know, when you go through diligence, the easier diligence is, the easier it is to talk about a higher valuation.
Yeah, we had a podcast with one guest who basically is on buy side, and he said, we want to move quickly, and if the target company, it takes them weeks to pull this stuff together, we just walk. One, because it messes up our timeline, but two, it's indicative of the fact that they aren't really operating their business based on a good data foundation.
Yeah, when I was doing this, the majority of my stuff was buy side, and they would bring in other big four consultants, and it was very clear to see who had just started working on this and were not data driven, and then who have lived their whole life data driven. And frankly, of the 25 deals I did, I only saw one that was truly data driven. And they were, they provided data to hedge funds, so they were pretty smart on it too.
Yeah.
So let's kind of get into how do we do this? And so you kind of said before, you got to speak the right way and make sure everything's calculated correctly. And so I tell companies, start simple and just build a monthly MRR waterfall. Everyone can kind of comprehend what do customer pay per month, and then you put that out across periods, months, and you can see who churned, who is contracted, as in they spent less this period versus last period, who has spent more this period versus last period, expansion, and then who is new, who was had no revenue last period but now have revenue. And it's very simple to build, very straightforward. There's some complexities around presenting it and making sure it rolls, which is very important, and they reconcile. Well, don't get reconcile now, but and then you calculate your GRR and NRR. And when a person builds this, they understand the drivers of NRR, and they get this. The next step is to make it operational and staying within a MRR framework, but showing it quarterly. And so now the quarters, they do roll from end of period to beginning of period. And we align this operationally because, sales happens in quarters. Finance closes books in months, but revenue teams think in quarters. That's part of the gap and the distance. And so now this is built for a revenue team, and there is additional data down here on logo counts. and we also get some visuals around average size. And you do this for each segment. So if you had a North America segment, a Latin America segment, or you had enterprise versus mid-market, would do multidimensional. You do this across those. And now we're getting really into the realm of using a BI tool. And then the third piece is when you've got that down, as you're going 2 exits, going into sell-side diligence, probably 2-3 months out, you convert it to an ARR waterfall, and you build each segment to provide visibility into the sales motions, like land and expand versus bundle or channel strategy. Then you have the ability to discuss pricing strategy, and then product strategy, and get the product portfolio, which is always a challenge, and then forecasting. Forecasting in Europe can sometimes be different than forecasting in North America. And so you build this out, and you see this is quite complex, but with the right expertise and guide, you can do this in probably 3 to 5 months.
So, question on this. When I think of gross revenue retention rate and net revenue retention rate, I think of it on a customer cohort basis. So our retention this period, our gross revenue retention is the ARR from the customers we had at the beginning of the period, less whatever ARR or MRR they churned or downsold. That would be the gross retention. The net retention would be just adding it up, expansion or upsell to that. I do believe that there's no such thing, unfortunately, as a proper definition, but I think that's the ideal definition. And the waterfall is okay on the monthly basis, because for most motions, the churn and the expansion is from the people that started with you at the beginning of the month. But as you start doing a kind of quarterly waterfall or an annual look using the waterfall, you introduce the possibility that some of that churn or expansion is from customers that you brought in during the period that you're looking at.
So this gets into
basically obfuscate the numbers a little bit.
So you're bringing, Scott, you're a smart man, and you're identifying some of the challenges that come with building an ARR waterfall. So I'll start with, there are, according to the SaaS standard definitions board, they highlighted there's 2 methods to calculate net retention. There's a cohort method, which we see that, like I pointed out in my LinkedIn a few days ago about, it was a Snowflake. We'll just take who we have now versus where they started and just calculate the end of period over the beginning of period, and that's their net revenue retention. Then there's the formula method. And this formula method is what you highlighted was beginning, less churn, less contraction, and that gets you gross, and then plus expansion gives you net. And that's a formula method. But when you put it in a waterfall view, you also have the visibility to see new. So you kind of get this like customer journey. I talk about these waterfalls as a way to see customer journey at scale. But to your point, when you get to an ARR waterfall, so right here, monthly, this is rolling from end of Q4 24 to Q1 of 25. But when you do an annual revenue retention, you're actually doing an annual look back. And so you would look back at Q2 should look back to, Q2 should look back to actually be end of period Q2 over here, which would be this one. It gets more complex. And that's why I start companies on a monthly MRR view to get grounded in the numbers before introducing complexities. When you go through diligence, it would be an ARR diligence on an annual view. If they show it on a quarterly, they will go back 12 months and compare. And that, Scott, gets you into that cohort of an annual cohort, and you're not going to see new people coming to that cohort except when they came in the beginning. And so that's how you handle the ARR view for a waterfall.
Yeah, and I think the point is for the audience just to be cognizant that the formula method and the cohort method, if you're looking at longer periods than a month, are likely to start diverging a little bit.
Yeah, it's more challenging
on the retention rates. And you should be careful of that. And I think it was Figma that you were referring to, not Snowflake. Is that
I did one Snowflake also.
Okay.
I did Snowflake with Clavio, and then Figma was a crazy one this past week.
Yeah, so let's talk about that just briefly. But as a general point, right? It seems like there was controversy around how Figma calculates ARR, and I'm not really looking to open up a Pandora's box here, but I want your opinion on why some of these important SaaS metrics, which are truly what the investment world uses to value these companies, are not governed or incorporated into something like GAAP, so that there is a single definition and and some legal accountability for misrepresenting the stuff.
Yeah, the legal piece is really interesting. I would tell you that when a company goes to acquire another company, there is an agreement on how to calculate net retention rate, and it's what I just showed you here. It is not the Figma method where we only look at customers over $10,000 spend, or we only look at customers over a certain time period, or Snowflake does a 2-year measurement period versus a 1-year measurement period. None of that matters when you go in private equity to acquire a company, because you agree on the terms. It is a well agreed upon metric. It's used everywhere, and that's what you go by. For public companies, someone's got to do something about it. I like the guys at Theta, Professor McCarthy. He's been advocating that all public companies provide a customer cohort chart, so you can actually see the number of customers per year and how they change. And he submitted that to the FASB and to the SEC, but nothing ever came of it. So
yeah, that'd be a good start. Anyways, let's keep going.
So yeah, let's dive into how do you read this wall of numbers? This is legit. And so on the right here, the way you always do analysis is through relative terms, through percentages. So these are percentage of beginning. I think that's you. Okay. And so I'll just walk through this here. So this example company grew 30%, grew more 30% year over year. So the beginning of Q2 24 was actually the end of Q2 24 was actually beginning of Q3. So that's where we get these numbers here. And the quarterly growth rate dropped 30%. So we went from talking about annual year over year to quarterly. And here's where we see the quarterly growth rate dropping. So you start with viewing, how is this company growing? Like, what's the growth rate? And then we want to go into what's driving growth. And so we use net retention as a proxy for customer base growth, because it is. You see that they had 105% net retention, which it means for every dollar it came in, the customers actually increased their spend another 5 cents. And so it's a beautiful metric. And we want to know what drove that net retention. It's expansion. And the math here is 8.3 minus 1.7, 1.6 gets you down to this 4.9 with some change in there. And so now we see that expansion rate is the main driver of this business. And we kind of jumps off the page here. Whenever we talk about relative rates, you should always go back to absolute values. And so this land and expand motion, they landed at 2,400 MRR per customer, and they add another 3,100 on top of that to create a $5,700 monthly recurring revenue customer. Pretty amazing, interesting business. There's some risk here around customer acquisition growth. So they went down from 14 new customers in Q1 to 8 and net negative new customers. We'll get into that here. I'm going fast at one time here. So the risk to this business is not churn or contraction. It's actually the ability to keep up the pace of growth. And so they're not growing fast enough to feed this expansion engine that's occurred. And so for a buy side person, they'd look at this like, wow, if I can get this customer acquisition motion going and humming and outpacing expansion, they can really drive growth of this business. And this is the way that you look at kind of like I say, it's like the answers to the test. Once you have this visibility, you can understand how you're being evaluated, and you can kind of shift and move ahead of time before you get hit with these kind of tough questions. And so I highlight right here is customer base is driving 70% of growth. That sounds great, but it shouldn't really be that high. I like the idea of like 2 to 1. So you have 10% new customers coming in, driving growth, and 5% coming from customer base. That's where I like to see things. And 2-3 years ago, it was 20% growth, and you had about 15% or 10 to 15% from new customers, and the remainder from customer base. So that's a quick view, and I'm going to kind of rush through this. So how does this benefit CFOs? I'm sure there's people on this call who have built a roll forward model and they just drag it over, but you get limited in Excel and you can't see it down at segment or multi-dimensional levels. When you put this into a BI tool, and I'm using Power BI for this one, you can push it into Excel, and just like this, now you can do a forecast, you can do scenario modeling, you can do a lot. And the main thing is the calculations are measures, they're agreed upon, they're signed off on. And so finance doesn't have a calculation for expansion. RevOps doesn't have a different calculation for expansion. You're on the same data model. You have aligned data strategy. You have governance. You have metric definitions. And now you can just work more efficiently and not have to trip over each other in meetings. So CFOs can integrate this into their planning. And then CROs, as I said before, they kind of get the answers to the tests. And so as we look at this from a quality of revenue, and this is how it would be spoken and presented in a diligence, is they've got 105% net retention rate, and the customer concentration is less than 10%. That's key. And then their effectiveness, this is where you get to identify, is someone kind of thought leader and talking head, or actually driving the go-to-market effectiveness in a data-driven way. And so we call out here the risk is the customer acquisition rate is too low. So was there a sales rep out on maternity leave or paternity leave? What happened here? And then the key unknown, which should be answered, is if they're driven by expansion, how many times will a customer expand, and especially at that rate? So these are the kind of things that would come out in the diligence that the CRO should know.
Yeah, I like the way you framed this of using the data to get to the narrative and making sure they're aligned. Because, otherwise, if you don't proactively get to that narrative, you're leaving it to chance that the people doing the diligence are going to come up with a different narrative. So I think this is very important.
100%. And then
one thing, if you go back just to the other slide the previous slide for a second. This one, the roll forward. And I certainly understand the importance of trying to keep models simple, because otherwise people just won't even build them, right? And maintain them. But, one of the things, just because my brain gets overly engineered sometimes, but I don't love new being in this model. I like to separate existing business dynamics, in one section and new on the next. And the reason would be, for example, you're applying, a 2% churn on a monthly basis to everything. So as soon as a new customer comes in the model, they'll be modeled at 2% less the next month. So again, though, I think the importance of simplicity cannot be overstated, because you want to make sure you have models. But there's kind of this trade-off between how deep you go to perfect it versus having it be actually exist.
That's a great call out, and that speaks to operationalizing the knowledge that you have, and then being able to apply it to drive value. Because too often people do over-engineer things and caught up in metric messes.
Yeah.
So let's talk about like the evolution for RevOps, and love to get your thoughts on this. My litmus test, Scott, and I'm curious because you've probably done this more than I have, is when you see a organization that cannot forecast within 5% on that current quarter or 8% the next quarter, that's a signal that they need to kind of go back and focus on the basics. And that's why I use my litmus test. And that goes back to, do you understand and have a detailed ICP or customer personas? Do you have a cohesive framework to actually run sales? And then do you have visibility on sales outcomes from activity and funnel performance? And until you are able to forecast and execute within 5%, focus on the basics. And then once you're able to do that, then you can look at moving forward to more advanced stuff. And I'll pause and love your reaction.
Well, my reaction is I like using that as the litmus test. I haven't thought about that before. but the term forecast actually gets the hair on the back of my neck up a little bit, because the vast majority of companies that we interact with, they say we need better forecasting, and all they're really talking about is that they want their sales leader to be more accurate when he or she says, here's what we're going to do over the next 6 weeks. And my view is all of that is bottom of the funnel forecasting, right? It's important, but it's typically too late to change course, right? Let's say your forecast says we got 3 weeks left in the quarter and we're going to come up 20% short. Oh, well. And so my view is, within this litmus test you're putting up, it's quarter plus 2 or quarter plus 3 is really important, because you need to actually be able to model your whole motion so that you can start looking at leads today. And that's the indicator of what you're going to bring in revenue, maybe 3, 4, 7 months from now. And that's, if you do that, then you have time to react and change course. But this obsession with bottom of the funnel forecasting, I mean, I understand that the CROs get tired of being embarrassed every quarter when they miss, but operationally, there's not a lot of value from being great at the next 2 or 3 weeks.
Yeah, it's great piece of advice there, Scott. I worked with a client as a PE fund. They had 8 companies that rolled up, and one of the portfolios was less than 20 million. And I built them this phenomenal forecast model. And then it came down to it. They didn't even have a list of prospects that they're going after that month. And I was like, oh my gosh, this is just got to get back to the basics. Who are you calling on this month? Well, here's our win back strategy. Here's 25 companies that we lost last year we're going after again. Here's our new customer strategy. We're going after customers who are acquiring people in the market. We're going to go try to get in front of them and close 2 or 3 of those. And just having the building blocks to get there and discuss it operationally. Because yes, on Friday, when you send out your end of week report, you want to say, here's our plan. Here's how many we contacted. Here's our activity. Here's our process. And that way people know what you're doing. Now, I'll take it one step further in this conversation. Is my other favorite framework besides an ARR waterfall is the pipe plus go get. And that really gets down to when you forecasted to miss by 20%, you should have known that go get amount ahead of time. And that's when you get to the operational plan of, okay, what you've been doing is only working for 80%. What is your plan to bridge the gap of this last 20% that is in the go get bucket?
Yeah, and again, you need to have time to go get it now.
Yes,
right? That's the importance. Is you have to have your forecasting good enough that it prompts you to take action within enough time that you have to take that action. Anyway, we're effectively out of time, but let's. This has been awesome, Will. Thank you again. Hopefully the audience feels the same way. But just see if there's any questions from the audience that we can maybe help with.
Let me stop. Let's go back to my thing here. I didn't see any questions come in.
Brianna's typing something.
There we go.
Yeah, just that we had a question about sharing the slides. I said yes, but they're your slides, so you can decide whether we can share those with the audience.
Yeah, I'm happy to.
Awesome.
Scott, I learned a lot from you. This was great. I hope the audience learned some things. I'm going to give how does Scale Matters use some of this methodology or your expertise?
Well, we do a lot of this. We've been really focusing on trying to drive go-to-market and finance together, and partially because, you talked about the strategic CRO. a lot of the companies we work in aren't yet at the level that they're hiring that person. And so we've kind of concluded, all right, we're going to need the CFO to help the revenue side, right? So we do a lot of work focusing on the CFOs and how they can help build these models, how they can help drive data integrity higher and that sort of thing for the revenue teams. And quite frankly, you shouldn't expect the CRO or CMO to have to be data expert. They're supposed to be the beneficiary of good analytics, not the people that know how to do the analytics. But that's what we've sort of assumed for too long is, okay, a good CRO, a good CMO is going to build all this stuff up. So we're trying to acknowledge that's probably not going to happen. So let's get people that are skilled at data stewards and analytics, which is the finance and FP&A side, and get them to help lift the revenue side. Guess we also have one question about calculating customer concentration numbers. Will, why don't you take that?
Yeah, it's a very simple one. It's percent of total revenue from customers. And so typically it's a large enterprise customer and what percent they make of. And the way you typically do it is you look at, if I look at 10% of revenue, can I organize that by how many customers that is, that makes up? And typically when you have smaller size tickets, it's going to be a lot of customers and you're not going to have customer concentration. Now, when you've got enterprise customers and their one customer is 10% alone, now you can say we've got one customer is 10% and these 4 other customers bring it to 20%. So you say we've got a bucket or a bundle of 5 customers that create 20% of customer of revenue, and now you got customer concentration.
My first company that I started and was fortunate enough to take public, we basically got all of our revenue from 4 companies, the telephone companies, and we did extraordinarily well, but it was always a little bit of a ding. And depressed our valuations a bit because they just looked at us as, any one of your customers goes away for whatever reason, you lose 25% of your revenue. So that's the issue, is the risk if you're highly concentrated and you lose one.
But if you didn't have them, you wouldn't have been there. So
exactly. Yeah, I was pleased with our customer concentration. So we talked about different ways, the formula way and the cohort way to calculate GRR and NRR. And we said that they possibly start to diverge in terms of what they show as retention rates as you look over a longer period of time. Any recommendation? Do people choose one over the other, or just need to be very clear about how they're doing it and the fact that people could interpret these things differently?
Yeah, so it's complex, and I would say start simple. And frankly, it starts with, does your company talk about its business on a monthly recurring revenue basis or on an annual recurring revenue basis? And I've been emphasizing MRR because it's easier for RevOps to reconcile back to revenue when they talk MRR. It's just, that solves so many problems. Now, when you get into actually the different obfuscations between GRR and NR, it actually comes with calculating at the customer level versus customer product level. That's when you get the movement, and to get a net number versus a more granular number. And so on that one, again, just focus on the customer level. So my recommendation to the person that ask this question is just start simple with MRR and do a GRR NR calculation formula method, which I showed here in a waterfall approach.
Yeah, it is certainly the simpler approach than keeping cohorted tables forever. Though you will, when you want to exit, there will be an expectation that you could show customer cohorted revenue recognition tables.
But once you have it built already in the NRR waterfall formula, it's easy to do that, and that's what we use in our Power BI moves.
That's true. Will, thanks, man. I know we went overboard. Thank you to those of you who were on the webinar, and hopefully you found it helpful. Will, how can people get in touch with you if they want to?
I'd say easiest thing right now is on LinkedIn. I always follow you, Scott, because you put out some good stuff. So Will Sullivan on LinkedIn, pretty straightforward.
Cool. Thank you all. Have a good rest of your day.
Thanks, Scott.